Hello, scholars. I'm Chauncey Joyce, and today I'm excited to teach you an important concept in corporate finance. And I put these together, the time value of money and discounted cash flow. These are really important valuation ideas you really need to understand. And I love this quote by Warren Buffett. There are only two variables you have to plug in to value any financial asset. That's simply the stream of cash in and out between now and Judgment Day, discounted at the proper rate of interest. And why I love this so much is it's a really clear idea that all of valuation in finance is comprised of three elements: timing of cash flows, the risk of those cash flows, and the magnitude of those cash flows. So the time value of money tools and the discounted cash flow tools will help us value any financial asset. So if you really had to invest a lot of time in any one topic in finance, my pick would be really understanding this idea. It underlies so much of what we do when we value financial securities. So with that, let's get started. This idea of intrinsic value, it's an all-important concept that offers the only logical approach to evaluating relative attractiveness of investments and businesses. It can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. So when I say things like value, we can reapply this. When we think about a single cash flow, well, the present value of a single cash flow is the future value discounted at the appropriate discount rate. The present value of multiple cash flows is the future values discounted at the appropriate discount rate. That could be things like college education savings. And then the present value of a bond is the future value of the coupons and principal discounted at the yield to maturity. So notice now we're just changing the terms, future values, now with coupons and principal, and then the discount rate is no longer called that, it's called the yield to maturity. Likewise, the present value of a share of stock is the future value of the dividends. That could be share buybacks as well, or any cash flows available to the equity holder discounted at the required rate of return. And then the present value of a firm is the future value of cash flows discounted at the WACC. The present value of a project, capital budgeting project that is the future value of the relevant cash flows discounted its cost of capital. The reason I wanted to show you this is so that you can start to see these ideas for valuation, right? We're going to use the time value of money and discounted cash flow approaches to tell us the value of something. And then we can reapply that concept to numerous ideas and topics in finance. So understanding this is really going to help you out later. So our outline is I'm going to show you all the key terms, and then I'll show you all the tools, all the equations that is, for both present values and future values of cash flows. Once we do that, we're going to practice each one. After we do that, we're going to talk a little bit about interest rates in part two, and then part three, apply this through loans and amortization and really get to this idea of principal and interest. So our key terminology here is about time value of money. That's a big concept that just says money's worth different values at different points in time. With students a lot, I like to share, if you were to receive $1,000, would you rather have that in 5 years or would you rather receive that now? So intuitively, they all say, I want that money now. And that's really because of the time value of money. We don't like to wait for our money, or if we do, it's not worth as much to us today as that amount we'll receive later. So the future value is just any value of an investment at some future point. And then compound interest is a very, very powerful concept. It's the idea that interest is earned on both the initial principal, so the initial amount invested, and interest will earn interest on that. So in finance, we often assume compound interest. Present value, when I say present value, I'm talking about the value today. I call that the value now, the current value, the present value, or T equals zero. That's time zero. Time one would be in 1 year. So all of those are synonymous with present value. Often in industry, you hear this called fundamental value or present value or intrinsic value. This is not the price. The price is what it costs to buy something. When you're computing a present value, that's the idea of it's the present value of future cash flows that we have discounted and in turn determined its value today. So Um, the next one is this idea of discounting. That's just a process of calculating the present value of future cash flows. The discount rate is the rate that allows us to calculate the present value. For now, perhaps you could think of that as risk. Higher discount rates could be proxies for higher risk investments. So what's the difference between TVM and DCF? Well, what I've noticed is when people say TVM or time value of money, we're generally referring to a single cash flow investment. So perhaps you're saving $1,000 today and you're in the process of computing what will that be worth in 40 years when I retire. That's one cash flow as the present and the future. Discounted cash flow involves multiple cash flows. So if you're going to value a stock, you're probably doing a discounted cash flow valuation analysis. You're going to forecast several years of dividends and then estimate the horizon value later. This idea of a discount factor, you're going to see it here in a minute applied in several equations, but the discount factor is 1 over 1 with r to the t. So your discount rate r is right there. And in fact, these are the toolbox. This is all the symbols we're going to use. FV for future value, PV0 for present value. And what I do with the subscript here is that's some point in time. So with a future value, that's at, if it's 10, I'm saying it's a future value 10 in 10 years. PV0, present value at time 0, or today. That's what I meant when I said I often write T0. T is number of periods. Financial calculators and some equations, you may see this called N, but think of this as number of periods, not necessarily number of years. R is a periodic interest rate in decimal form. If you're finding a present value of something and you're given the future values, it's called the discount rate. Now, if you have present values, the process of finding a future value, this R is now called a compound rate. So these are really related concepts, the discount rate and compound rate. It just matters on what point in time you're moving. Your future value factor is this. It's 1 with r to the t, and you can see the future value here. So in the process of computing the future value, we multiply the present value by this future value factor. That's why it's called the future value factor, because we're multiplying it by the present value to determine the future value. Here, it's a little bit harder to see this next one, but this is that present value factor. So I'm just going to expand this second equation out, and you'll see future value at time t. You're multiplying that by 1 over 1 with r to the t. That's the same thing. So again, it's called this factor because we're multiplying it by something else. It's really right here. I'm just separating it for you so you can see. Now, key terms, I'm going to use these throughout the lecture here. So uneven cash flows are a series of uneven cash flows. So each year, the cash flows are different. We call those uneven cash flows. Annuities are a series of equal cash flows over finite time. So I call them fixed cash flows, finite time. If the cash flow is fixed and finite, it's considered an annuity. To recognize these in certain questions, someone may say, I pay $1,000 per month for 1 year. That's an annuity. The $500 is fixed. The 1 year is the finite time. There are two types of annuities. Most of the time, you're going to be seeing ordinary annuities or regular annuities. That occurs when the first payment is at the end of the period. That's synonymous with the cash flow starting next period. The point is they're not starting right now. They're starting at the end of the period or the beginning of the next. Annuity dues, on the other hand, those are always starting at the beginning of the period. So I'm going to show you equations that may help you differentiate the two. A growing annuity is a growing stream of cash flows with fixed maturity. So each cash flow is increasing. So if I go back to that rent example, rent's a good example of an annuity due. It's due on the first of the month for most people. And if rent goes up, say 1% per month, then your first payment is 500, your next one is 505, the next one increases from there. Perpetuities are annuities, so that payment continues forever. So the time aspect never ends with a perpetuity. Growing perpetuities, each payment stream is growing and it's continuing forever. In part two, we're going to talk a little bit more about interest rates and get to this idea of periodic rates, annual percentage rates, and effective annual rate. Sometimes they're called effective annual yield or annual percentage yield. But this is important when we are talking about the effects of compounding over large periods and even understanding what APRs in a contract implies when it gets to actual cash flow. Then we're going to talk about loans. Some of those key terms are principal, the amount borrowed, amortizing, the process of viewing a schedule that includes all those payments and how much are principal and interest, and you can see that balance turning down over time. Mortgages, we'll talk about foreclosure, but really we're going to spend a lot of time on amortized loans. So again, here's the symbols. The new ones on this slide are C, or cash flow. That's the cash flow per period. Maybe think of it as a coupon payment or just PMT payment. But on your financial calculator, this is also called PMT. The rate is the IY, interest per year. I like to think of that as interest per period. N or T is your number of periods, and then G is the growth rate per period. So we'll get to this later on, but just be consistent. When I keep saying periods instead of years. So that's an important idea. If the question deals with things like months, then time needs to be measured in months and the rate needs to be monthly. So we're going to talk about a rate per month or rate per period in that case. And then the payment or C has to be per period. So that's what I mean down here when I say be consistent. So if something in the problem you're working on is maybe monthly savings, then you have to value the cash flows on a monthly basis, discounted or compound at a rate per month over a number of months. So again, that valuation key idea is that valuation is all about timing of cash flows, risk of cash flows, and magnitude of cash flows. All of those then need to match when we do our valuation. So the timing is in accordance with the number of periods. The rate is a rate per period, and the cash flow occurs per period. So don't worry, we're going to get to a lot of practice of that. Until then, let's just do the math now. Let's see the equations we're going to use. This whole slide are all PV or present value tools. I love to see these. These are the tools we have in our toolbox. We're going to practice them, and then we're going to start to apply them to more difficult concepts. But for now, look at the basic structure. I define the cash flows. When I say uneven cash flows, what I mean is a series of uneven cash flows over a period of time. Notice the subscript on these are going to be different. Those future values are all different. But I love to visualize timelines. As problems get more and more challenging, the way I think of valuation, again, it goes back to timing, risk, and magnitude. So I like to put time on top. That's the year or the period, I should say, when I expect to receive or pay some cash flow. The magnitude is down here. And then the risk, for now, I'm going to consider that how I determine my interest rate. It's a proxy for risk for now. That allows us to calculate the present value, or if I were moving in this direction, the future value. So notice on this page, all of these are present value tools. So you're going to see all of these cash flows being discounted to time zero or today. Again, T equals 0 is my notation for time today. So here, all we have to do is just reapply this equation on each future value. So if I have a promised stream of cash flows of, say, $100 here, or 200 here, and then 300 here, and 400 here, I have to value each of those separately. So perhaps it's probably more appropriate to put a sigma, which is nerd for add them up. Do each one individually, then add them. So we'd have to value each of those. Now the annuity, again, that's fixed cash flows or equal cash flows for finite time. I like to say fixed and finite because it's much more memorable. Once you're into the annuities, there are two types. So you have your ordinary and your annuity due. Ordinary annuities, again, if the question doesn't specify, you should assume it's an ordinary annuity. Those are most common here. So look at this. Time zero, no cash flow is being received today. The first payment here is received in 1 month, or in one period, I should say. And then the second one, notice the subscript is not changing, like I had a subscript down here, and that's because each of these are fixed. So it C1 equals C2 equals C3, etc. So these are the fixed cash flows. Each of these C's are of the same amount. Perhaps you could think of a mortgage loan, right? Each monthly payment is the same. So this is the tool, and don't worry, if you're really intimidated by formulas, I'm going to do a lot of this through formula first, but then show you the shortcut through a financial calculator. And the reason I like to do that is we shouldn't think of these formulas as magic or anything. Our financial calculator is magic. This is just math. And once you understand it, it's going to be much easier to apply it when you see it as a new question. Annuity dues, take a look at this. If some of you are very formulaic based, this equation may make sense, but most of us perhaps are not. If, let's assume this is a 10-year annuity at the top, these last two, I've just put dot, dot, dot. We're going to change these last two to time 9 and then to time 10. So here, the first cash flow occurs at the end of the period. And again, the reason I say that's synonymous with the beginning of the next period is, the end of the month, the 31st of that month at midnight, is about the same thing as 12:01 a.m. the next day or whatever at the end of the month. So here you're still getting 10 payments. They're just moved up one period. So I just shifted this entire stream of cash flows to start one period earlier. That means there's no cash flow received exactly in 10 years. In fact, that last one is the beginning of the 10th year, which is the end of the 9th. Okay, so how does the formula show that? Well, that first cash flow needs no discounting. So you just taken one of those future cash flows and subtracted that. So you just have to add it here. So the reason is you could think of this as, well, I don't need to value that first cash flow because I already know its contribution to present value. That's starting right now. So I just have to add that to the present value of the future ones. And the present value of the future ones, well, like we said, there are 9 future cash flows. You could think of this as you're just stripping out one of those payments, bringing it forward, and your annuity now is one less period. Don't worry, I know this is a little bit tricky. I know it's not necessarily intuitive, but I think we will get better with practice. So here you go, growing annuity. This is one of my favorites. I just love the idea that these payments are increasing over time at a rate of G%. So when you see this notation of C times 1 with G, really what's going on is the payment is increasing. Why is the 1 in there? Well, if it's growing at, say, 5%, let's just put in a payment of 500 and it's growing at 5%. You see this often in finance, 1 with R or 1 with G. And what does it mean? Well, it's growing. So when you distribute this in, you're going to receive the initial principal, you could think of as that 1, plus all the growth on that, which would be 25. So that's 525. That's why you're always seeing this 1 with R or this 1 with G over and over again. We've seen it up here too. I know these may look intimidating or scary at first, but the more we practice them, the better we're going to get. The reason the timeline may help you is these can be tricky. This is the rate the cash flow is increasing. Now, while that cash flow is increasing over time, we are still in the process of determining its present value. So we need the discount rate moving in this direction to the left. Again, G is going in this direction. So your perpetuity, it looks just like an annuity. However, the only difference is it continues forever. So that's what I put here, this infinite sum. And growing perpetuities, you see the first payment is C, and C will increase at a rate of G% per year forever, over and over and over again. And this may look really simple, but the idea is kind of elegant about it in that we use this actually a lot more than you may think. We value mature companies this way. If the cash flows are very predictable, we can just calculate a present value with just these 3 variables. Even if it's not a mature company, you see this often in stock valuation or firm valuation because you can get to a terminal value or horizon value. So I'm skipping ahead a little bit, but I want to show you that this is a pretty important idea. Sometimes you hear it, I consider it a growing perpetuity. Sometimes you hear it called the constant growth model, constant dividend growth model, but the growth is constant. Often Gordon growth model or dividend discount model, but this one gets reapplied quite a bit when you get to equity or stock valuation. Now, this whole slide, print this all out as well. These are your future value calculations. So here again, we have definitions, we have equations, and we have timeline. If the timeline is not intuitive to you, I consider you to practice it and think about it and start writing these out, because once you learn these tools and you get into what they say the real world and you start applying these things, it's very, very helpful if you can consider all valuation decomposed into just three elements. One is the timing of those cash flows. The second is the risk of those cash flows, and think compound rate, discount rate for now. And then the third is the magnitude or size of those cash flows. So timing, risk, and magnitude is really what we need for valuation. So, it can be easy to get lost in the weeds once we're starting to see equations like this, but don't forget that main idea. Again, all that's different here is when we're moving in this direction, we say we're compounding. On the previous page, we were moving in this direction to the left and calculating the present value. We say we were discounting. So again, I love this. I love to save money, so I love thinking about compounding, and I'm excited to share this passion with you. So all you have to do is timing of the cash flows on top, and then each of these cash flows are different, so you really have to calculate these differently. And so perhaps it was maybe more appropriate if I put a sigma in front of there. So we're going to do each one individually and then calculate them through. Again, we have annuities, so I outline these in the same exact order. These are fixed cash flows, finite time. Ordinary annuities, again, they start at the end of that first period, which you could consider the beginning of next period. That's a tricky idea. Maybe think of it if these cash flows were annual. Well, the end of the period, if today's January 1st, the end of the period is December 31st, which is essentially 1 year from now. It's just like January 1st. So sometimes you see this called the end of the period or beginning of next period. Again, the only way out is through here. In this case, we're just going to have to practice these tools, learn from them, and just keep practicing. I consider finance a very shots on goal. My hockey fans may understand what that means. It's a very shots on goal type of study. It's not intuitive. You just got to keep shooting the puck, and eventually it'll go in. So the only way to get better is practice at this. Annuity dues, take a look. Time is still the same in each timeline, but what you're noticing here is these cash flows are just shifted one period over to the present. So what that means, this equation is the same, but since you invested this one early, you could think of just getting one free compounding. Okay, Chauncey, what's that mean? Well, would you rather start saving for retirement now, annuity due, or in 1 year, ordinary? So you may say, well, starting now, I get more chance to compound. I get, one more period. Well, that's exactly right. That intuition is reflected right here in this formula. We get one additional free compounding by starting now. I mean, you often hear people say, start early, save often, all these advice. That rings true. And we can see that, starting early lets that time grow to a bigger amount. That's why I love finance so much. I mean, I made a subtle joke earlier that compounding is really a powerful idea. Look, it's powerful here. You're raising it to the power of time. It's the power of time. So I love sharing that joke. It's a powerful idea. But all joking aside, especially if you're young, look at the variable you have a lot of control over, which is time. Perhaps rate is not guaranteed, right? You can determine how much you save, but if you're young, the earlier you start, I should say, then the runway time is a lot longer. And that's the, look, it's the most powerful one. It's in the exponent, it's powerful. That really, really delivers you that interest on interest compounding effect that really hockey sticks the chart. So valuations just go through the roof at those later years. Growing annuities. This is one I love to think about when I do my own investing. But what is happening is maybe you save money one period, and the idea is to save a little bit more every period. And that's what I do when I get a raise. I stack it. So what I like to do is maybe I got a 2% raise. I increase my savings by 2%. So that's one way to apply it. Or if you're really, really frugal, you just save all of that raise. We don't have future values for perpetuities or growing perpetuities. Those would just go on forever. So we don't put those in there. All right, let's get to work here. We're going to apply all of these. And again, that first slide I showed you there was all present value. So let's get to work. I'm going to show you this valuation first through the formula. What you're going to do is if this cash flow is in year 0, again, if that's not intuitive, when we say present value, again, that's time 0. So that first cash flow of 200 is 1 period away. The second cash flow is 2 periods away. In this case, these are years. Third year, we're receiving 600. And then in the fourth year, we're receiving 800. So I think a common mistake, if you're doing this for the first time, is to think that this is occurring right now, but that it's not. It's in 1 year. Time 0 is now. That's the present. So what we do is we're going to take this first cash flow received in 1 year, and we're going to discount it 1 period. So 1 with R, if our discount rate is 12%, 12% is the same as spot 1-2. So you move the decimal twice, and you're doing a formula, and you just discount that 200 one time at 1 plus R. Discount the second cash flow of 400. That gets discounted twice. It's occurring in year 2. Third cash flow of 600 in 3 years. 800 in 4 years. So you would just do all those individually. The other approach is to use your financial calculator. And this is the approach I actually prefer teaching, because a lot of my students end up going into either financial planning or perhaps pursuing their CFA charter, and they just like the financial calculator, just makes things a little faster. So let's take a look. Let's apply this valuation question to the financial calculator. And so here, this is a financial calculator. This is a Texas Instruments BA2 Plus emulator. First thing I like to do is see more decimal places. I don't know why I'm this way. So to do that, go second, this yellow second button, and all the way down this spot button, this decimal for format, second format. It's saying decimals is 2 right now. I like to see all 8. That's maximum. 8. Don't hit equals at the bottom. Hit enter at the top. And then you can clear out of that. All right, so what I like to do, these are uneven cash flows. You can use the cash flow feature. Cash flow, as soon as you click this, there may be numbers populated in there from your last work. So go over here to second, all the way then at the bottom to clear work. That'll zero everything out. It's asking the cash flow at time 0. What is that? It's 0, right? That first cash flow of 200 occurs in 1 year. So I'm going to scroll down, and that's cash flow stream 1, and that's $200. Enter. Down. The next prompt is for the frequency of that stream of cash flows. This 200 only gets 1, so I'm going to leave the frequency at 1 and go down again. Cash flow 2, 400. Enter. Down. Again, leave the frequency at 1. I only get that cash flow 1 time. Cash flow 3, 600. Enter. Down again, frequency of 1. So I'm going to go down again for my 4th cash flow. Well, that's 800. Enter. I've entered timing and magnitude. The one piece we need is risk. So for now, we're going to think of that as our discount rate. So to do that, these 3 buttons work together: cash flow, NPV, and IRR. So I'm going to go compute net present value. Our discount rate is 1.2 for 12%. Your financial calculator is reading that as 12%. So there's no need to move the decimal and put in spot 1.2. It's just 1 to 12%. Enter. Down. and then you need to go back over and hit compute. If you got lost in those steps, I typed them out here. So it's just cash flow, second clear work. And here, the NPV, we get the same result. It's $1,432.93. Love sharing this example. UC does not cost this much, but let's go with it. Your sister has just been accepted to UC. She will start 1 year from now. That's an ordinary annuity. The cash flows will be starting at the end of the year, which is the beginning of next year. So her tuition will be $45,724. If you're not sure what this looks like, all this is just put it on a timeline. Just outline those. That's time 0, t equals 0. Cash flow 1 is 45724 for 4 years. So I'm just going to do ... That will repeat for 4 years. 45724. So that's the setup. Now, on your financial calculator, this is an annuity. So these 5 buttons work together. N for time, IY for rate, either compound or discount, PV for present value, PMT, and future value. So if you're not clear what those are, let me just go over here and write those out. So on your financial calculator, again, it's assuming timing, risk, and magnitude are true for valuation. So this is time 1, ... all the way through, well, we could do time 1, time 2, ... all the way through time n. How many numbers of periods? So that's the n, that first prompt you see there. The payment would be here. That's a cash flow that's fixed and finite. They occur every period. And I just drew this ordinary annuity in this case. Your future value, think of as a single cash flow in the future. And your present value is a single cash flow in the present. So you're valuing each of these things and calculating a present value or a future value in one direction or the other at the discount or compound rate, I over y. So all of those are really what those variables represent. N, timing, IY risk, PV, payment, future value are your magnitudes. Timing, risk, magnitude. That's important for valuation. So what do we need to do to actually solve this question? Let's go back to it. So we have this 45,724 per year for 4 years. Fixed cash flow, finite time. Well, that's my annuity payment. So I'm going to put PMT. My payment is 45,724. I need my IY. My IY is 6.5. Now your calculator knows that that's a percent. And time is 4. It's happening. That stream of cash flows is happening for 4 years. And future value is 0. Why is future value 0? Well, think of it this way. You are only trying to value the 4 years of cash flow. There's no additional single cash flow or lump sum at the end. You don't have to pay this massive fee for graduation later. You are only going to value these 4. So we're going to discount those 4 to determine their present value. So we have to leave future value in there at 0. So then we just go for compute and then present value. So let's type all these in, see how we did. For $5,724 is your payment. 6.5 is your rate. 4 is your n, number of periods, and 0 is your future value. Now, up at the top, compute present value. It's saying it's negative, but that's okay. You could think of this as that's the amount you need to invest today, cash outflow, in order to receive those payments later, to have those payments, to withdraw. So your calculator does have that funny setting there, but don't pay too much attention to it. The answer is still correct. It's 156,641 you need to save today. So if you save that today, you could think of that now back in our timeline. Again, it's very helpful to think about all of valuation as timing, risk, and magnitude. If you invest this amount today at time 0, you can compound it for 1 period, make yourself a payment, compound what's left, make that payment, compound what's left, Compound what's left again. And once you get to that fourth payment, after you pay that fourth payment, the balance in that account you had saved is now 0. And that's exactly everything we typed into the financial calculator. Same thing, but now your sister's going to go to school with you today. Aren't you excited? So here we go. Only thing you need to do is for this case, it's now considered a 3-year annuity plus a single cash flow. So take a look at that. That's the formula I pulled down from the previous page up above. And it's a 3-year annuity. Add that present value. That is 4 cash flows there. Now, financial calculator approach is a little bit faster. All those inputs are actually the same. Be careful with this one, though. Your payment is 45724 again. Your rate, in this case, we're going to call it a discount rate because it's the present value. So we're going to use the discount rate 6.5. And time is still 4. Future value is 0. And we're going to compute for the present value. But before we do that, we need to focus on this payment button and take a look right above there. It says begin. We are assuming the default approach of ordinary annuities. So you can get to this by going second payment for begin. Right now it's in ending mode. That's usually what you want to leave it in. Now you go second set. Now it's in beginning mode. Let me show you that again. It's second payment. To change it back to ending, you go second set. Now it's in end. I recommend just leaving your calculator in the ending mode because most of the questions are going to be ordinary annuities. So second payment, second set. Now we're in beginning mode and she's starting today. We're going to assume those cash flows start today. So all I have to do, all of these were entered on my right-hand side. They're still in there. I'm just going to go ahead and compute present value. And take a look. Maybe some of you were expecting this number to be higher, 166,822.89, and your intuition would be correct. Why is that? Well, these payments are now moved up a period, so those are now more valuable, you could think. So it's going to cost a little bit more for your sister to go to college if she starts right now than if she was able to save right now and then compound those savings before she's making those payments. This next question may be the trickiest one on the whole packet. Let's take a look at it. Your 1-year-old daughter wants to go to UC. Good for her, wanting to be a Bearcat. So she's 1. That's irrelevant. Really, we just care about the timing of the cash flows. She's planning to start in 17 years, which is when her first payment is due. Tuition will still be $45,724 per year for 4 years. So this is really important to get the timing right. On questions like this, if you're unsure what to do, just you could put time equals 0 here. You have period 1 up through period 16 where there are no cash flows occurring. And then from 17, 18, 19, and 20, that payment of 45,000 will start. So I'll just put 45K, 45K. So that can give you the visual. Now, it's really a 2-step approach. If you're going to do this, the formulaic approach, the one thing you need to recognize is you've got an annuity here. It's a delayed annuity, though. So you have to value that annuity, and if you do, it'll tell you the present value or the value of that annuity at time 16. So that would be step 1. And then step 2 would be determining that value today. So it would need to get discounted 16 periods. So on a formula, what it would look like is this. Present value today is equal to the annuity. So I'll just rewrite that equation. Actually, that may be helpful. It's C times 1 less 1 over 1 with R to the T over R. That will tell you the value of the education 1 period before the cash flows start, right? That's an ordinary annuity. So value at 16. That's very tricky. That's usually the crux, the hardest part of this question. So on that, if you're unsure Why is it 16 versus 17? Let's go back to those tools we have in our tool belt. We're looking at an ordinary annuity here. So if I'm assuming now the cash flows are occurring starting at 17, 18, 19, and 20, well, when I determine this value, it's going to give me the value using this tool one period before that cash flow starts. So it's not times 0. In fact, it's times 16. So that we're going to determine the value at times 16. And then what we're going to do is consider that a single cash flow at times 16. And then we're going to calculate the present value of that today. So it's a combination of these two tools. So this piece, that would value the annuity at times 16, and then you multiply it by a factor, a discount factor that is, at 1 with R to the T. So when I fill all this out, that C, that payment stream is $45,724 and times this monster factor here. Let's just make sure we're all right. I had to move the decimal on that 6.5%, so 0.065 and add it to 1. And this time here is that because it's related to the payments, is really how many payments you need to make. So if you're getting mixed up on time, I can see how, but just think this is an annuity that values fixed and finite payments, and there are 4 fixed and finite payments with that stream. So again, what I just written here, that's the value at 16. Then you need to discount that value. So you could just, instead of multiplying it by this discount factor, you could just divide that answer by 1.065 to the 16th. Now, most students here will actually put 17 there. And again, that would be a mistake. Think back to, we used an ordinary annuity to value it, so that cash flow starts at the end of the period, which means when you determine its value, there's 1 discounting in there. So that's going to be 1 less than the time the cash flow starts. So that's the most common mistake I see my students make. Now, did we do this before? Yeah, actually, in fact, we did. We actually calculated this. Take a look. This is when the cash flows start 1 year from now. So that figure in orange, we'll actually get that same answer of $156,000. So you could just rewrite this over here. Don't worry, there is a shortcut to doing this, but I like to do the formula because I think it helps build some intuition about what's going on here. So in orange here, the value 156,641.22. And then that number gets discounted 16 periods later. And if you do this correctly, I mean, I can show you on a financial calculator. It takes a little bit longer to do it this way, but the correct answer would get you to $57,188.98. So let's take a look. There's more than one way to solve these problems. Actually, in this one, my preferred approach is actually using uneven cash flows approach, that cash flow feature on the financial calculator. Seems unintuitive, but let's take a look how I do that. I'm going to go back to cash flow and click second clear work. That zeroes everything out. So 0 there, right? So I'm going to just write it out here. My first cash flow, so I'll put cash flow 0 is 0. And then scroll down on my financial calculator. The first stream of cash flows, CO1 is 0, but this is going to have a frequency. Sorry, my cat's walking on the screen now. Hey, bud. The frequency here is 16, not 17. The next piece, so I'm going to scroll down after my frequency there is 16. Oops, let's backspace. 16. enter down. Cash flow 2 is that 45,000. It's cash flow stream 2. Think of it as the second stream or pattern of cash flows. $45,724. Enter down, and that stream has a frequency of 4. It repeats 4 times. So let me write that out because I think when you think of this as a timeline, it may help you. So the second stream of cash flows or second pattern is $45,724, and that frequency of the second cash flow was 4. So again, where's the mistake? It's right here. Typically, students will put a 17 as opposed to a 16, but there are 16 zeros right there. Then at times 17. It says cash flow 2. Your financial calculator knows that that cash flow starts at time 17. So if you're unsure what I did with those, again, cash flow 0 is 0. I'm going to scroll down. The first pattern or stream or payment of cash flows is 0 for a frequency of 16. The second pattern is the amount of the tuition, and the frequency of that is 4 years. So now all you need to do is compute net present value, prompt it with your discount rate. Which is 6.5. Enter. Some students say equal, but when you hit enter, you'll get that equals there. And then you go down. You have to recompute each time. You get that same answer we get with this approach earlier. That's not magic, that's math. So I don't want you to think of the financial calculator as some kind of magical thing here. It's really just doing this. It's really just doing this. And you know, whether you apply this to Excel or whatever, if you can start to teach yourself of thinking of valuation as timing, risk, and magnitude, well, the financial calculator can only do this part for you, right? And once we know how to use it, it makes our lives a little bit easier. So you may have come up with a different approach. If you did, feel free to share it with me. If you get the same answer, it's correct. So the present value on this one, the net present value is 57,188.98. So again, the same response we got with the formula. Why do people do the formula? Well, when I took corporate finance as an undergraduate, we were not allowed a financial calculator, but we're finding it more and more used in things like CFA and CFP examinations, so we do teach it. So let's move on to finding the present value of a growing annuity. So the cash flows are going to grow in this case. So in this case, I like to use the formula because there's just not an easy growth button in here. So I'm going to just use the formulaic approach. Let me rewrite that out for you. So your future value, sorry, present value, so I'm going to write PV 0. The value today is equal to C times this factor, 1 less 1 with G over 1 with R to the power of T time, over all of that over R less G. So if we fill this out correctly, we'll get the present value today is that first payment. So zoom out so you can see it a little easier. That first payment of 20,000. And then times 1 less 1.03 over 1.10 to the power of time. In this case, the time is 40 years over R less G. Why am I having to move the decimal rate? Well, we're using a formulaic approach to solve this, so we need to convert that percentage into decimal form as opposed to percentage form. So let's see what we get. 1.03 over 1.1 equals, that's the term there in soft brackets in the numerator, y to the x right here, that'll raise it to an exponent, y to the x 40 equals, now I've solved the term, second term on that numerator. That has a negative in front of it, so I'm just going to make it negative down here. combine it with 1, right? That's the same thing as 1 less this number. So plus 1, that's the numerator. And we're going to divide by the denominator of 7%. That's the present value factor for a growing annuity. That term there is 13 times. And then multiply it by that first payment, 20,000. And you will get $265,121.57. Oh, perpetuities. These are fun. These are fun. You may not think they exist, but they actually do in the financial world. So let's start to value them. What is the value today of an asset which will pay you $122 per year forever? So you do have that fixed cash flow, but that forever piece tells you it's a perpetuity. The present value of that today, PV 0, again, that 0 represents time, present value times 0 today, is just C over R. It's just that first payment divided by the rate. So it's 122 divided by 0.11. So all we need to do is go back to our financial calculator, clear that out. 122 over 0.11 is $1,109.09. Now, all right, we solved this question, but what does it really mean? Sometimes it's hard to think about what this is, but what that is that's your present value. If you thought of it this way, if you invested this amount today, well, how much would it grow to next year? Well, next year, let's just do a timeline here, because I think that will prove helpful. If this is today, let's say we invest $1,109.09 at time 0. Well, that will compound in 1 year to what? Well, it's going to compound by a factor of 1 with R. So 1 plus R is 1.11. Okay, so what? Well, let's do the math. Times 1.11 equals. Well, now the balance is 1,231.09. Now you can make yourself a payment of 122. And what do you think you'll get? Multiply. Oh my gosh, negative 122. Well, you get back to that initial balance. So essentially here, this is just making yourself a payment of the interest. And maybe you saw that if you cross multiplied these, look at this equation. We are just essentially in that, if you cross multiply here, multiply both sides by R, however you call it, you take the present value times R, that's the interest you're earning each year. You're just living off the interest. If you saw the great finance movie of Batman or any thereof, he's a trust fund baby. Ideally here, he's just going to live off of the interest that those initial balances are invested at. And then it's going to compound, and that's what he can live off of. Maybe not $122. Consider it millions then, whatever. But that's how the math works. And this just is repetitive. Again, at the end of the first year, that's going to get compounded and grow. You're going to make a payment of 122, and it's going to go right back to 110909. So hopefully you can start to think about these things rather than just being formulas, but in terms of a timeline, timing, risk, and magnitude. So that's really what separates students that really get it versus those that maybe just want to see the formula and they're just going through the method of operation. But I encourage you to think through what you're doing and see how it could be applied. Other cases you could apply this could perhaps be university endowments. The idea there is you're saving an amount and you're really relying on it earning interest to make certain payments for things like scholarship, buildings, professor salaries. I love that one. Let's wrap up with our last growing at perpetuity, our last one here. So it's just present value today equals C over R less G. How do I know that's a growing perpetuity? Well, the expected dividend on a share of stock next year, right? So in 1 year, is 130, and they're expected to grow at 5% forever. That's my growth. Discount rate or required return for stock is R. What's the value of this dividend stream? So that's 130 over 10 less 5%. If you do this correctly, you will get the answer of $26 per share. And that wraps up our showing of all of the present value tools we learned from above. And the next time we are going to pick up all these. So you have all your tools. I encourage you to print this out, think about them, start training yourself there to think about all valuation, be it stocks, bonds, cash flows, firm, is timing, risk, and magnitude. So I tried to outline that. Your tools are here. There are shortcuts, of course, with a financial calculator or Excel, but don't lose track of what's going on. It's all about timing of cash flows, risk of cash flows, and magnitude of cash flows. Time, risk, magnitude. So with that, we are going to pick up next time with the future value examples.